Day traders generally execute trades in the course of a single trading day, while investors buy and hold stocks for days, weeks, months, and sometimes even a couple of years. In between these two extremes are other forms of trading. These include swing trading and position trading, among others. I strongly suggest readers take seriously the option of diversifying his trading account, and other than day trading option strategies, add a mid or long-term approach in order to get fewer fluctuations in the overall portfolio. That's why you will learn here the basics of the portfolio diversification, because if you are a complete beginner, using only day trading strategies will expose you to huge loss over a long period of time, due to the large intrinsic leverage of options and day trading strategy in general. Swing trading is where a trader buys an interest in a commodity or stock and holds the position for a couple of days before disposing of it. Position trading, on the other hand, is where a trader buys a stake in a commodity or stock for a number of weeks or even several months. While all these trades carry a certain element of risk, day trading carries the biggest risk. A trader with the necessary skills and access to all the important resources is bound to succeed and will encounter a steep learning curve. Professional day traders work full-time, whether working for themselves or for large institutions. They often set a schedule which they always adhere to. It is never wise to be a part-time day trader, a hobby trader, or a gambler. To succeed, you have to trade on a full-time basis and be as disciplined as possible. Introduction to diversification. Diversification is considered an effective risk management technique. It is widely used by both traders and investors. The gist behind this approach is that investing funds in just a single security is extremely risky, as the entire trade could potentially go up in smoke or incur significant losses. An ideal portfolio of securities is expected to fetch a much higher return compared to a no-diversified portfolio. This is true even when compared to the returns of lower-risk investments like bonds. Generally, diversification is advisable not only because it yields better returns, but also because it offers protection against losses. Diversification basics. Traders and investors put their funds in securities at the securities markets. One of the dangers of investing in the markets is that traders are likely to hold on to only one or two stocks at a time. This is risky, because if a trade was to fail, then the trader could experience a catastrophe. However, with diversification, the risk is spread out so that regardless of what happens to some stocks, the trader still stands to be profitable. At the core of diversification is the challenge posed by unsystematic risks. When some stocks and investments perform better than others, these risks are neutralized. Therefore, for a perfectly balanced portfolio, a trader should ensure that they only deal with assets that are non-correlated. This means that the assets respond in opposite ways or differently to market forces. The ideal portfolio should contain between 25 and 30 different securities. This is the perfect way of ensuring that the risk levels are drastically reduced, and the only expected outcomes are profitability. In summary, diversification is a popular strategy that is used by both traders and investors. It makes use of a wide variety of securities in order to improve yield and mitigate against inherent and potential risks. It is advisable to invest or trade in a variety of assets, and not all from one class. For instance, a properly diversified portfolio should include assets such as currencies, options, stocks, bonds, and so on. This approach will increase the chances of profitability and minimize risks and exposure. Diversification is even better if assets are acquired across geographical regions as well. Best diversification approach. Diversification focuses on asset allocation. It consists of a plan that endeavors to allocate funds or assets appropriately across a variety of investments. When an investor diversifies his or her portfolio, then there is some level of risk that has to be accepted. However, it is also advisable to devise an exit strategy so that the investor is able to let go of the asset and recoup their funds. This becomes necessary when a specific asset class is not yielding any worthwhile returns compared to others. If an investor is able to create an aptly diversified portfolio, their investment will be adequately covered. An adequately diversified portfolio also allows room for growth. Appropriate asset allocation is highly recommended, as it allows investors a chance to leverage risk and manage any possible portfolio volatility because different assets have varying reactions to adverse market conditions. Investor opinions on diversifications. Different investors have varying opinions regarding the type of investment scenarios they consider ideal. Numerous investors believe that a properly diversified portfolio will likely bring in a double-digit return, despite prevailing market conditions. They also agree that in the worst-case scenario will be simply a general decrease in the value of the different assets. Yet, with all this information out there, very few investors are actually able to achieve portfolio diversification. So why are investors unable to simply diversify their portfolios appropriately? The answers are varied and diverse. The challenges encountered by investors in diversification include weighting imbalance, hidden correlation, underlying devaluation, and false returns, among others. While these challenges sound rather technical, they can easily be solved. The solution is also rather simple. By hacking these challenges, an investor will then be able to benefit from an aptly diversified platform. The process of asset class allocation. There are different ways of allocating investments to assets. According to studies, most investors, including professional investors, portfolio managers, and seasoned traders, actually rarely beat the indexes within their preferred asset class. It is also important to note that there is a visible correlation between the performance of an underlying asset class and the returns that an investor receives. In general, professional investors tend to perform more or less the same as an index within the same class asset. Investment returns from a diversified portfolio can generally be expected to closely imitate the related asset class. Therefore, asset class choice is considered an extremely crucial aspect of an investment. In fact, it is the single most crucial aspect for the success of a particular asset class. Other factors, such as individual asset selection and market timing, only contribute about 6% to the variance in investment outcomes. Why diversifications between various asset classes? Diversification to numerous investors simply implies spreading their funds through a wide variety of stocks in different sectors, such as healthcare, financial, energy, as well as medium caps, small and large cap companies. This is the opinion of your average investor. However, a closer look at this approach reveals that investors are simply putting their money in different sectors as stocks class. These asset classes can very easily fall and rise when the markets do. A reliably diversified portfolio is one where the investor or even the manager is watchful and alert because of the hidden correlation that exists between different asset classes. This correlation can easily change with time, and there are several reasons for this. One reason is international markets. Many investors often choose to diversify their portfolios with international stocks. However, there is also a noticeable correlation across the different global financial markets. This correlation is clearly visible, not just across European markets, but also in emerging markets from around the world. There is also a clear correlation between equities and fixed income markets, which are generally the hallmarks of diversification. The correlation is actually a challenge, and is probably a result of the relationship between structured financing and investment banking. Another factor that contributes to this correlation is the rapid growth and popularity of hedge funds. Take the case where a large international organization, such as a hedge fund, suffers losses in a particular asset class. Should this happen, then the firm may have to dispose of some assets across the different asset classes. This will have a multiplier effect as numerous other investments and other investors will, therefore, be affected, even though they had diversified their portfolios appropriately. This is a challenge that affects numerous investors who are probably unaware of its existence. They are also probably unaware of how it should be rectified or avoided. Realignment of asset classes. One of the best approaches to solving the correlation challenge is to focus on class realignment. Basically, asset allocation should not be considered as a static process. Asset class imbalance is a phenomenon that occurs when the securities markets develop and different asset classes exhibit varied performance. After a while, investors should assess their investments, then diversify out of underperforming assets and instead shift this investment to other asset classes that are performing well and are profitable in the long term. Even then, it is advisable to be vigilant so that no one single asset class is overweighted as other standard risks are still inherent. Also, a prolonged bullish market can result in overweighting one of the different asset classes, which could be ready for a correction. Diversification and the relative value. Investors sometimes find asset returns to be misleading, including veteran investors. As such, it is advisable to interpret asset returns in relation to the specific asset class performance. The interpretation should also take into consideration the risks that this asset class is exposed to, and even the underlying currency. When diversifying investments, it is important to think about diversifying into asset classes that come with different risk profiles. These should also be held in a variety of currencies. You should not expect to enjoy the same outcomes when investing in government bonds and technology stocks. However, it is recommended to endeavor to understand how each suits the larger investment objective. Using such an approach, it will be possible to benefit more from a small gain from an asset within a market where the currency is increasing in value. This is as compared to a large gain from an asset within a market where the currency is in decline. As such, huge gains can translate into losses when the gains are reverted back to the stronger currency. This is the reason why it is advisable to ensure that proper research and evaluation of different asset classes are conducted. Currencies should be considered. Currency considerations are crucial when selecting asset classes to diversify in. Take the Swiss franc, for instance. It is one of the world's most stable currencies, and has been that way since the 1940s. Because of this reason, this particular currency can be safely and reliably used to measure the performance of other currencies. However, private investors sometimes take too long to choose in trading stocks. Such activities are both overwhelming and time-consuming. This is why, in such instances, it is advisable to approach this differently and focus more on the asset class. With this kind of approach, it is possible to be even more profitable. Proper asset allocation is crucial to successful investing.